Welcome back to the show this morning at 6:34 as we get this pre-hump day edition going here. It is Tuesday already. I don't know what happened to Monday.
Connie came in the kitchen this morning thinking it was Wednesday.
Yeah, I'm sure he did.
I said, got some bad news for you.
The problem is Connie's so tall. So Connie, if you don't know my partner, Connie Mack, he used to play professional basketball. So he's like 12 feet tall.
Exactly.
Right. So he's so tall that it is Wednesday for him. So
he can see Wednesday from here.
Exactly. It's so intimidating too, right? I mean, tall people are very...
you think you're intimidated? You've got a foot on me.
It's very intimidating. Really tall people are very intimidating.
And I can't reach anything in the kitchen.
Right. Yeah, he puts everything on the top shelf.
Yes.
It's not like what I do for my wife at home. Stuff I don't want her into, I put it on the top shelf. She gets so mad at me. I've been tempted. You know, when you were little, I don't know if you had one. I had this stool growing up. It was a little step stool.
Yeah, a step stool.
And it had writing on it that says, this stool is for me, so I can reach things that I'm supposed to see.
Yes.
It was like if I had to go in the bathroom or whatever, I could get what I needed. So I've been threatening to get my wife one of these one of these step stools. She's like, she's going to kill me. Pretty much. Anyway. So I've got a letter coming out on Monday of next week. And the point of the letter that's coming out, or it's the blog post that's coming out on Monday, is about the recent Berkshire-Hathaway meeting that was held. So Warren Buffett every year has a big, showcase. It's his annual conference and talks about Berkshire-Hathaway with all his shareholder meeting. And he releases a letter. Every year he releases his annual report, his letter. And it's well read, and everybody reads it, et cetera. And there was an interesting gem inside of this year's letter, and I'm writing a report on this. He says that over the course of the next decade or so, we could very well have a 50% correction in the market. Well, that's pretty sobering. But he says, don't worry about it, because just bet on the long term of the U.S. economy. I'm with you there, right? Now, he's recommended more than once that investors should just buy an index fund, forget about it, and just let it work over the long term. Completely fine. Even if you have a 50% correction of the way, it's okay. Just bet on the long term of the markets. And he says, and he made a very interesting point. He says that over the course of the next few years, next decade, stocks will outperform bonds on a return basis over that period of time. That's not a hard assumption to make. First of all, yields right now on the 10-year Treasury are about 1.4%. So for yields to go to zero, there's not a huge amount of return left in owning 10-year Treasuries from 1.4% to zero. So let's say, though, over the next decade that I bought a 10-year Treasury that's going to mature in 10 years. So I buy it today. I buy a brand new issued 10-year Treasury today. It's going to mature in 10 years. And it's going to yield 1.4%. So at the end of the day, when I add up all my return, I get my money back. Now, the great thing about a Treasury is that when it matures, I get 100% of my money back, first of all. Second thing I get is I get 1.4% a year on my money. So it's a money market account, right? That's what it is. But that's what I'm going to get over a 10-year period. Now, valuations on the S&P 500 are currently 30 times earnings after yesterday's decline. When markets historically have a valuation of 30 times earnings, so 30 times what companies earn, that's what the price of the market is, that suggests that forward returns over the next decade are going to be somewhere around 2 to 3% on stock investments. So he's right? So just simply doing the math, if I buy a 10-year Treasury in 10 years, I get my money back plus 1.4%. But if I just buy the S&P 500, I could get 2% to 3% over the next decade. So I would definitely make more money in the stock market over that time frame. However, saying that, the question is whether or not you will survive the 50% decline. Psychologically, emotionally, most investors will sell when they get a 50% decline. There was a lot of people yesterday hitting the sell trigger yesterday on a 1,000-point decline. Can you imagine what a 10,000-point decline would do on the Dow? And what investors would be doing? Oh, it can't happen. It's happened twice before. The other point about this is that the volatility at the end of 10-year periods, I get all my money back with treasuries. I don't get my money back with stocks. So if that 50% decline occurs at the end of the cycle and I sell at that point, I could be in far worse trouble. So there's a psychological and behavioral component to investing that people need to understand. But when you start equating rates of return, what's going to perform better than something else over a period of time, you also have to factor in your ability to survive that time frame. But there's another point about this, and the bigger point that I want to make. The bigger point is that Warren Buffett says that you should always bet on the U.S. economy. Stocks will outperform bonds. Okay. Then why do you have $130 billion worth of cash in U.S. Treasuries instead of invested in the markets? If you believe what you're selling, right? Now, remember, Warren Buffett is a huge Democrat, right? So big supporter of Mike Bloomberg for president. But if you believe what you're selling, then why do you have $130 billion worth of cash? Why didn't you invest that money into an S&P index fund? If you believe what you're selling and you believe what you're telling people, then why didn't you invest all that cash you had sitting around while you were waiting to find an investment to put it into, right? To buy a new company, whatever it was. Why didn't you put that into an S&P index fund and follow your own recipe? Because if you had, and this is the point of my article, your investors in Berkshire-Hathaway would have made $90 billion more over the course of the last decade than they made in the stock currently. By not even following your own advice and investing $130 billion in treasuries, you cost your shareholders $90 billion. That's with a B, a buh. B, billion dollars. It's a lot of money. It's about a 4% annualized return gap over what investors got versus what they should have gotten or could have gotten if you had followed your own advice. And this is and the point about this is that be careful who you listen to. Warren Buffett's talking a message, right? He's supporting Mike Bloomberg. He's got his own biases and issues. And so be careful when you listen to people. Yes, he's a very, very smart investor. He has done a fantastic job. He has made billions of dollars for his shareholders. No doubt about that. Nobody's arguing it. And my point is be careful what you listen to, though, because this is one of those classic cases of do what I say, not what I do. As an investor, you might want to pay attention to what he's doing rather than what he's saying. And he's holding a lot of treasuries for a reason, because treasuries are safe. Treasuries provide you protection in the event of a market downturn like yesterday. This is the value add of having fixed income in your portfolio. This is why when we build a portfolio, when we structure an investment philosophy, we talk about mitigating risk. Bonds play a very, very important role in that structure. About 2 weeks ago, we added a bunch of bond exposure to our portfolio because we were worried about the downturn that occurred yesterday. So when the downturn occurred yesterday, the markets were down, a little over 3% yesterday. Our portfolios were down just barely over 1% because of adding fixed income, because of the hedges we're running, those type of things. So much lower volatility allows us to take our time to make the right decisions for the next move. And that's the point of managing risk and talking about this. But this is, and this is why Warren Buffett owns a lot of treasuries, right? He's waiting for an investment. He's waiting for that buy cheap opportunity, which is what you want, right? We want to buy stuff cheap. We want to sell it dear. And even in his letter, he said, I can't find anything to buy. Everything's too expensive. And that's the message you should be listening to. That's not the message that the media is spinning out of this. All you hear about from Warren Buffett is the fact he says, hey, stocks are going to outperform everything else over bonds over the next decade. Buy stocks. That's not the message. Listen to what he's doing, not what he's saying. And you'll be a much better investor over time, like Warren Buffett. And if you want to invest like Warren Buffett, just start out with $1 billion and there you go. We'll be right back.
Yes, I did. Let's go down and check out the show. Yeah, they were dancing and singing and moving to the grooving. And just when it hit me, somebody turned around and shouted, play that funky music, white boy.
Real
Financial Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.